All right, welcome to today's Explainer. Looking ahead to 2026, the multifamily real estate market is, well, it's a completely fascinating landscape right now. I know there's a ton of noise and confusion out there, but we're going to cut straight through all of that. We're diving into the actual data, checking out exactly what the smart money is doing, and unpacking how top-tier operators are quietly finding massive success. Let's jump right in.
So the million-dollar question on everyone's mind, is multifamily real estate actually still a strong play? If you've glanced at any financial news over the last couple of years, you've definitely seen the scary headlines, right? We're talking rapidly rising interest rates, shifting policies, and this massive record-breaking wave of new apartments hitting the market all at once. Honestly, it's enough to make anyone want to just hit pause. And look, that caution, it's totally understandable. The ground shifted. Strategies that were total slam dunks a few years ago have literally hit a brick wall. But as we're about to see, a shifting market absolutely does not mean a dead market.
Whenever things get a bit bumpy, every single market cycle basically splits investors into two distinct camps. First, you've got the waiters. These are the folks who just sit on their hands, park their capital, and hold out for perfect market clarity before making a move. But spoiler alert, perfect clarity almost never arrives until the opportunity is completely gone. Then you have the opportunists. These are the disciplined players who actually dig in and find the opportunities hiding inside that uncertainty. And heading into 2026, the dividing line between these two mindsets, it's sharper than ever.
To really understand that opportunist mindset, we kind of have to look at what's driving the fear. Let's talk about the headline story that has everyone so spooked. From 2022 through 2024, developers dropped an enormous wave of new apartment units. In some markets, especially across the Sun Belt, it created the largest supply pipeline we've seen in decades. And yeah, naturally flooding a market with that much supply creates immediate short-term pressure on both rents and occupancy. That's the headline. That's exactly what the wetters are reading and stressing over. But let's peel that back and look at the real story. The real story is hiding in this one massive number, 70%. That is the dramatic, massive drop in new rental housing construction starts from their recent peak. As developers got totally squeezed by crazy interest rates and skyrocketing construction costs, they just stopped breaking ground. Through 2025, construction starts fell so hard, they hit their lowest volume in over a decade. The headlines are obsessing over the buildings opening their doors today, but this 70% drop, that tells us exactly what the market is going to look like tomorrow. Basically, the construction pipeline is thinning out, and it's happening incredibly fast. This is just basic supply and demand. As that big wave of new supply slows down to a total trickle over the next couple of years, the existing built-in demand for housing is going to quickly soak up those vacant units. And what happens when supply drops while demand holds steady? Vacancies go down, and rents gradually get pushed right back up. This rapidly thinning pipeline is the exact reason why the current market is so incredibly compelling, if you know where to look.
Now, you might be wondering, okay, but what about that demand? Are people still going to need to rent? Well, just think about the cost of buying a home right now versus renting a comparable unit. Even with a few localized market corrections, buying a house with current mortgage rates is still way more expensive month to month than renting. That financial gap between owning and renting is extraordinarily wide. And as long as that massive gap exists, rental demand isn't just surviving, it is rock solid.
And this leads to a super fascinating demographic shift. Look at who today's renters actually are. We aren't just talking about folks who are priced out of buying. We're seeing high-earning professionals who could technically afford to buy, but they're actively choosing to rent. Because of that affordability gap, they're staying in the rental pool for much longer. But here is the real kicker. They still want a fantastic place to live. They are more than willing to pay a premium for quality. Add in the fact that wages have actually outpaced rent growth over the past 3 years, and you are left with an incredibly strong, resilient customer base that's totally ready to pay for the right product.
All right, so supply is dropping, demand is super strong, and renters want quality. So how do we win in this environment? How do we actually capture this opportunity? Well, if you look at brand new Class 8 construction, those guys are having to compete fiercely right now. They're handing out crazy concessions and lease-up incentives just trying to get bodies in the door. But the real magic, the massive hidden potential, actually lives inside older properties. Let me break down exactly how this works. Okay, this is hands down my favorite part, the value add engine. Let me give you an analogy. Think of passive, speculative real estate investing, kind of like a sailboat. You're out there on the water, completely dependent on the wind, the market to push you along. Wind stops, you stop. But the value add strategy, that is a motorboat. You really don't care what the wind is doing because you've built your own engine. Building that engine takes 3 steps. First, you identify a property with real operational upside. Maybe the rents are way below market or the place needs some serious updates. Second, you execute a highly disciplined improvement plan. Fix the management, upgrade those kitchens, clean up the exterior. And third, you close that gap and extract the yield. You literally engineer your own momentum. I really want to slow down here for a second because this concept is absolutely crucial. This is what we call forced appreciation. It means increasing a property's net operating income, or NOI, through sheer execution, rather than just waiting around for the market to magically lift the value of your asset. Going back to our motorboat analogy, this is the throttle. You're not crossing your fingers hoping the building next door sells for a crazy price to boost your value. You are going in, making the property run smoother, making it significantly nicer so it commands a better rent, and directly increasing the cash it generates. And when that net operating income goes up, the mathematical value of the building goes up. Period.
Which perfectly lines up with this quote, and it really captures the whole value-add philosophy. You're not betting on the market, you're engineering the outcome. It's a massive mindset shift. When you rely on forced appreciation, that mathematical link between income and property value, it doesn't suddenly break just because interest rates tick up or some scary new headline drops. By controlling the execution, you're basically wrapping your investment in a protective buffer.
And hey, you absolutely don't have to just take my word for it. Let's look at what the heaviest hitters in the industry are up to. Recent surveys showing institutional investor preferences highlight two huge allocations. Value-add strategies capture 35%, and Core Plus, which is actually very similar, grabs another 35%. That is 70% of the smartest, most disciplined capital in the world pointing directly at this strategy. They see the construction pipeline shrinking, they see the locked-in rental demand, and they know that right now, execution over speculation is the smartest, safest bet. This is not some fringe idea. This is exactly where the smart money is going. But there is a catch. Value-add investing is definitely not passive for the people actually running the deals. Let's compare speculators to true operators. Over the last couple of years, the speculators are the ones who got completely wiped out. Why? Because they took on way too much bad debt, they blindly assumed rents would just go up forever, and they totally dropped the ball on actually running the properties. Now contrast that with elite operators, like the team at Deko Capital, who are emerging from this cycle stronger than ever. Their secret? Underwriting conservatively, managing the assets with incredible tightness, and building real, transparent relationships with their investors. It all boils down to extreme operational discipline.
So, what does all this operational discipline mean for you, the passive investor? Well, if you're a working professional wanting your money to actually work for you, value-add multifamily offers some insane advantages. First off, you get a clear, execution-driven path to returns. Second, you are totally off the hook for trying to perfectly time the market, which is impossible anyway. Third, you avoid buying at absolute peak pricing and just hoping for the best. Instead, you're partnering with specialized operators who have done the math, uncovered the upside, and built that high-powered motorboat engine to capture it for you.
As we wrap up this explainer, I really want you to take this one thought with you. Uncertainty doesn't eliminate opportunity, it concentrates it. Right now, this market is heavily rewarding precision. The supply pipeline is shrinking, the demand is totally locked in, and the properties out there that just need some operational love are sitting at a discount. For the operators who've built the right infrastructure and kept their discipline, this is literally the exact moment this strategy was designed for.
Which leaves us with one final question for you to chew on today. Are you waiting for the market to get easier, or are you finding the opportunities that exist right now? Are you going to be a waiter, sitting in a sailboat just praying for the wind to pick up? Or are you going to be an opportunist, jumping in the motorboat with a team that actually knows how to steer? The data's clear, the strategy is proven, and the opportunity is literally right in front of us. Thank you so much for hanging out with me on this explainer. Keep learning, stay focused, and we'll see you on the next one.